For more than half a century, Warren Buffett has been writing these letters to his shareholders. And they're way more than just corporate updates. They're basically a masterclass in how to think about investing, business, and even life. So our goal here is to take those thousands and thousands of pages and boil them all down into a clear, simple playbook, using Buffett's own words in his own numbers.
So let's start at the beginning. In his early days, Buffett was known for what he called the cigar butt approach. Just picture it. He'd hunt for businesses that were just statistically dirt cheap. The idea was simple, really. Find a struggling company, buy it for a song, get one last free puff of profit out of it, and then move on. Kind of clever, right?
Well, here's the thing. The man who basically perfected this strategy now says it was a foolish mistake, a huge one. He actually points to buying Berkshire Hathaway itself as a prime example. He was tempted, he says, because the price just looks so cheap. What he learned, though, is that with a bad business, as soon as you solve one problem, another one just pops up. As he puts it, never is there just one cockroach in the kitchen.
Okay, so this huge foundational mistake, it actually forced the single most important pivot of his entire career. The one that really made him a legend. So what was the big shift? He completely flipped his formula. 180 degrees. Instead of buying those struggling cigar butt companies at a wonderful price, he started focusing on wonderful companies, even if you had to pay a fair price for them. And that line, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price, that is the absolute heart of the entire Buffett playbook.
All right, so that begs the question, right? What exactly makes a business wonderful? For Buffett, the answer is something he calls an economic franchise.
And his definition is it's brilliantly simple. He looks for a business with a product people either need or really, really want. Second, you can't easily find something else to replace it. And third, the government isn't telling them what to charge. You find a business like that, and you've got yourself an economic fortress.
These franchises have some incredible qualities. They can often raise their prices without losing customers. That's pricing power. They earn really high returns on the money that's invested in them. And get this, they're often so strong that they can survive bad management. Buffett's line is that a bad manager might hurt the profits a little, but they can't actually kill the company. Now that is a strong business.
Let's look at this in action. The best example is See's Candies. So, when Berkshire bought it in 1972, it was making about $4 million in profit on about $7 million in assets. Pretty good. But fast forward to 1991, and those profits had just exploded to over $42 million. But here's the real magic. See's didn't need to build a bunch of giant new factories to get that growth. Over the years, it generated hundreds of millions in profits that Berkshire could take and use somewhere else, all while needing just a tiny fraction of that reinvested back into the candy business itself. That's the power of a wonderful company.
But hang on. Where did Berkshire get the money to buy these wonderful businesses in the first place? Well, the answer lies in Berkshire's original business, insurance, and its secret engine, a little something called float.
Buffett's definition is the best one. When you buy insurance, you pay the premium today, but the insurance company might not have to pay out a claim for months or even years. That giant pool of money they're holding in the meantime, all those premiums collected but not yet paid out, that is the float. It's money they hold, but don't technically own.
The mechanics here are so simple, but so powerful. Berkshire collects the premiums, holds onto that float, and then invests that massive pool of money for its own benefit. And here's the kicker. As long as their insurance businesses are run well, this float is basically a giant loan that they get for free.
And just look at the scale of this thing. From less than $20 million back in 1967, Berkshire's float has grown to a staggering $147 billion. This mountain of capital is the rocket fuel that powered the acquisition of all those wonderful businesses.
Okay, so you own a wonderful business and it's gushing cash. What do you actually do with all those profits? This brings us to the next big chapter in the playbook, how to think like a real owner, not just some manager. This is the big question. It's called capital allocation. If a company earns $1, should it reinvest that dollar to grow the business, or should it just give it back to the owners? Buffett is very clear that most managers get this completely wrong.
Buffett uses this great analogy of a schizoid CEO. So, picture a CEO who runs a bunch of different businesses. He'll tell one of his subsidiaries that's not earning great returns, hey, send all your profits up to corporate. Makes sense. But then that same CEO, whose own parent company might also be earning low returns, will illogically hoard every penny instead of giving it back to his shareholders who could probably invest it better somewhere else.
So Buffett came up with a simple test. A business should only keep its profits if it can check two boxes. First, does it have a good place to put that money that will earn a high return? And second, for every single dollar the company keeps, does it create at least $1 in market value for its owners over time? If it can't pass that test, it's got to send the cash out.
And this all brings us to the final and maybe the most important principle in the entire playbook. It's the bedrock belief that makes this whole long-term strategy even possible.
Buffett calls it the American tailwind. It's this deep, fundamental optimism in the engine of American business. It's the belief that no matter what scary headlines you see, no matter what crisis we're in, the combination of human ingenuity and a market economy will just keep creating immense value over time.
I mean, the proof is in the history books. Just look at the 20th century. The Dow went from 66 to nearly 11,500. And think about what happened during that century. 2 world wars, the Great Depression, countless recessions, and through all that, the trend was just relentlessly upward.
What this really teaches us is that all the short-term panic and volatility, that's actually a friend to the true investor. Betting on the long-term progress of great businesses, powered by this American tailwind, well, it's been a winning strategy for a long, long time. And Buffett believes it's going to stay that way. As he wrote right after the 2008 financial crisis, America's best days lie ahead.
So that's the playbook. Get past the cigar butts, buy wonderful businesses at fair prices, understand the engines like float that power them, think like an owner, and have faith in that long-term tailwind. And really, it just leaves us with one final question. What economic franchises, what modern-day See's candies are hiding in plain sight all around us?